Hey guys, welcome back to the channel. In this video, I'll be comparing two of my favorite REITs available in the stock market, WP Carey, ticker symbol WPC, and Realty Income Corp, ticker symbol O. I'll be discussing the differences in their business models, management, and how this can be seen through some of the most important metrics for REITs. Make sure you stick around because at the end of the video, I'll be answering the following question. If I could have only one REIT for the next 10 years, would it be Realty Income Corp or WP Carey? If you have been with the channel for a little bit, you would know that we have a goal of hitting 2,000 subscribers by the end of this year. So if you like the content I produce, make sure to join the elite 15% of my viewers that are subscribed, and like the video so others can see it. And before we jump into the video, understand that everything in this video is my opinion, and the information in it should point you in the right direction for your own research, not to tell you what company to invest in. As I mentioned earlier, I do like both of these companies that we'll be looking at today, and they operate in very similar markets. However, there are a few key differences between the two that investors need to be aware of, but let's start with all the similarities in the companies. Now, both Realty Income Corp and WP Carey are real estate investment trusts that specialize in triple net leases. What this means is they buy properties, and then other companies or tenants pay to operate their businesses out of those buildings that these companies own. The triple net part means that in addition to the regular monthly rent payments, the tenants are responsible for paying any additional expenses that come with the property, like real estate taxes, insurance, and maintenance expenses. Not only do WP Carey and Realty Income Corp sign the same kind of leases, but they also purchase the same kind of buildings, which are like the ones you can see on screen now. Buildings that are specifically built for one large tenant to use that are not connected to a mall or other buildings. Because of all these similarities, investors tend to compare them, and many like one more than the other based on some of the following factors that I'll talk about. So let's start with an overview of the companies, which will start to reveal some of the key differences between them. The first key difference is their size. As of the time of preparing this video, and the time it should come out, Realty Income Corp has a current market cap of $21.6 billion, while WP Carey, which is not a small company by any measure, is 42% smaller with a market cap of $12.5 billion. This just means that the stock market overall values these companies differently, but that is largely driven by the difference in the total properties owned. Realty Income Corp owns 6,500 properties, which is a ton more than the 1,200 owned by WP Carey. This means that Realty Income Corp may have a better competitive position because it can be very hard to steal market share from somebody bigger from you. However, on the flip side, WP Carey has a higher growth potential than Realty Income Corp. Furthermore, these two REITs operate in slightly different geographical regions. WP Carey has properties in many different countries, including the United States and multiple in Europe, while Realty Income Corp has decided to focus their efforts on the United States market. Both of these strategies have their pros and cons, and I don't necessarily prefer one over the other, but it is important to keep in mind now because geography does play a role in some other differences to come. The next difference between these companies, and I would argue the largest and most important difference, are the tenants that they have in their properties. Up first is the occupancy rate of their portfolios, which has been and still is a very strong point for both of these companies. Right now, WP Carey has an occupancy rate of 98.9%, and shortly behind them is Realty Income Corp at 98.5%. This means that for both of these companies, the amount of revenue lost by having an empty building is very small, or less than 2% of their total potential revenue. and this is much better than the majority of their competitors. Up next is the amount of tenant diversification that these REITs have. The concentration numbers that you guys can see reflect the amount of each REIT's revenue that comes from their top 10 tenants, and a lower percentage here is better because it reduces the risk of losing a substantial amount of revenue if a couple large tenants do not renew their leases. However, the amount of diversification that these REITs have only matters if the tenants that currently pay them are stable and safe companies, because it doesn't matter how well the REIT is diversified if a large part of their tenant base could go out of business, declare bankruptcy, or break their lease agreements. To sum this up in a single figure, 48% of the revenue that Realty Income Corp receives is from an investment-grade company, while only 22% of WP Carey's revenue comes from investment-grade companies, which means another company like S&P or Moody's believes that the company is very safe and has a very low likelihood of not paying back their obligations. If we dive into the top 10 tenants of each REIT, we can clearly see why Realty Income's tenant base is considered stronger than WP Carey's. Realty Income Corp focuses on leasing to massive companies that are needs-based, which means that even when the economy goes bad, people will still need to buy their products. In a recession, companies like Walgreens and Walmart and dollar stores thrive because they offer products that are staples in the consumer's life at very low price points. However, WP Carey's tenant base is a little less safe, and the tenants are smaller, as I have not heard of the majority of them before looking into this company. This can allow WP Carey to charge a little more for rent, but it also means they're taking on more risk by signing these tenants. And the last point to touch on when it comes to their tenant base is the REIT's WALT, or weighted average lease term. The higher this number is, the better it is, because it means that the current tenants will not have the option to leave the spaces for a longer period of time. WP Carey has the edge on this one at 10.7 years, but Realty Income Corp is not far behind at 9.0 years. Overall, WP Carey is willing to take in riskier clients for longer and more profitable lease contracts. And when looking at occupancy rate, it looks like they've done a good job managing this risk so far. This is in contrast to Realty Income Corp, who focuses more on super stable companies and is willing to forego some profit potential to have the stability of these companies paying them every single month. Next up, we'll take a look at their dividend practices. As a general rule of thumb, I try to keep my dividend portfolio's yield somewhere around 3%. And both of these companies pay out substantially more than that, which means there's no wonder why REITs tend to be a cornerstone of a lot of dividend investors' portfolios. Right now, WP Carey has a higher dividend yield at 5.89%, while Realty Income Corp sits at 4.51%. Another special thing about these two REITs is that they pay out dividends on a monthly basis, which means that every single month you own these, you will get a deposit into your account in the form of a dividend payment, whereas the majority of dividend-paying companies only pay out dividends quarterly or every 3 months. Over the past 5 years, both Realty Income Corp and WP Carey have increased their dividend payments every single year. However, Realty Income Corp has grown theirs slightly faster at about 4.38% each year compared to 2.36% yearly. And this leads us into their dividend payment history as a whole. Realty Income Corp is part of a very select group of stocks that are known as dividend aristocrats because they've paid out a dividend and increased the payments every single year for the last 26 years. To give some context, of the 500 companies that make up the S&P 500, only 63 of them can be called dividend aristocrats, and only 3 of those are REITs. This isn't to say that the payment history of WP Carey is bad, because 9 straight years of dividend payment growth isn't anything to downplay. However, it does show how the difference in strategy can lead to different outcomes. These two REITs have been publicly traded for a very similar period of time. However, Realty Income's dividend growth streak is nearly 3 times as long as WP Carey's. And I believe a large part of this is due to the selectivity in their tenants. Now, if you guys made it this far, I hope I've made it clear that both of these companies are incredibly solid. However, if I had to choose one company to invest in, I know which one of these REITs I would choose. However, before I say which one, please make sure you like the video, subscribe, and leave a comment below, because I try to answer all of them if I see them, and it helps out the channel substantially. Now, if I did not have the option of investing in both of these companies, which I actually do right now, I would have to choose to invest in Realty Income Corp over WP Carey. This comes down to the difference in their business model, which in my opinion comes down to limiting unnecessary risk. Realty Income Corp chooses to focus on their domestic market in the United States because they understand the market and risks more intimately. They choose tenants with great resources and non-discretionary products, and this leads to great outcomes, like outperforming the general stock market by nearly 50% over the last 26 years, and their great history of continually increasing their dividend payments. I've done individual analyses of both of these companies in the past, which include many of the points I covered in this video. However, if you want any more information on either company, make sure you watch those in the real estate playlist that will pop up on your screen in a second, and I will see you guys in the next video.